Hi, welcome to StockX. I'm your host, John McPhee. I'm a cyber professional and stock market enthusiast. However, I'm not a licensed financial professional, and I encourage you to speak to one before making any financial decisions. That being said, I do believe you can get some great insight out of my content, and if you agree, please like and subscribe. Today I want to talk about option trading, the risks involved, and understanding the Greeks behind each option. Companies allow for option trading in addition to buying and selling traditional stocks most of us are familiar with. However, trading an option is much different than trading common stock. There are significant risks involved that I want everyone to understand before deciding on whether or not to trade an option. Options are much riskier than buying a stock because options will expire after a certain period of time. This is true for both call and put options. You may be wondering, what's the difference between a call and a put? The difference is simple. When you purchase a call, you are essentially making a bet that the stock price is going to rise, which means you are bullish. While if you buy a put, you are essentially making a bet that the stock price is going to drop. This means you are bearish. If you purchase a call and the price rises above the strike price plus the cost of the call option, you will see a return. This is known as being at the money. The same is true for put options. If the stock price falls below the strike price plus the cost of the put option, then you are in profit or at the money. Options that have not reached the strike price are known as in the money, unless the strike price is higher for calls and lower for puts than the cost of the stock. This is known as out the money. I do not recommend new traders buy out-the-money options. There can still be profit on these, but it is much more difficult to obtain. Now you may be wondering, what is a strike price? A strike price is a predetermined value in which the underlying assets can be purchased. The strike price is set by the seller of the call or put option. To be brief, a shareholder who holds 100 or more shares of a company can sell a call in order to gain profits. You do not need to own 100 shares to sell a put. However, you do need enough money in a margin account to cover the cost of 100 shares at the set strike price. The seller is hoping your option will expire out the money. This way, they can keep their shares plus the cost of the option that you have paid. Why is it necessary for a seller to have 100 shares before selling a call option, or have a margin account with enough capital to purchase 100 shares at the set strike price before an option can be sold? Well, this is because options have a 100 multiplier associated with them. When you buy an option call or put, you have the ability to exercise that option. This means you can purchase the 100 shares in the contract at the set strike price. When you purchase an option or put, you are only paying 1/100th the cost of the 100 shares at the strike price. For example, let's say I buy a call option with a $60 strike price. Let's say the cost of my option contract is $1.50. I would need to pay $1.50 times 100 in order to buy this contract. That would be a total of $150 per contract. Let's imagine we purchase one contract at this price. If the call fails to meet the cost of my option plus my strike price, the option will expire worthless. My risk is only the capital I initially paid. In this case, I would lose the $150 I paid for the option. However, I can choose to exercise my option before the expiration date and purchase the 100 shares outright. In order to do so, I would need to pay the strike price times 100 for the 100 shares. In this scenario, this would be a total of $60, which was our strike price, times 100, which is the amount of shares in one contract, which would equal $6,000 total. Why would someone want to exercise an option if it is out the money? The reason is if you do not exercise your option and the option expires worthless, then you will lose your initial investment of $150 per contract. If I decide to buy the stock outright, I can use the negative balance for tax purposes. Or I may want 100 shares of the company regardless of the price paid. Now, this isn't common. In most situations, you would be better off to buy the stock outright instead of at the strike price if it is not at the money. Why would you want to pay more for a stock that you could buy cheaper on the market? Well, if your option is not at the money, but close to the strike price, you may want to exercise the option in order to obtain the 100 shares at that strike price that you have access to. Imagine a strike price of $29 and the stock is trading at $28.90 right before expiration. In some circumstances, it may be beneficial to buy the stock at the slightly higher price in order to secure the $29 per share price you have guaranteed access to. If I didn't exercise because I could buy the shares a bit cheaper and I put an order to buy 100 shares at $28.90, that order needs to fill before the stock rises in price. If that doesn't happen, then you may end up paying more after all. That decision will be up to you to make based on the circumstances at that time. More commonly, an option will be exercised if the buyer has the capital to purchase the 100 shares at the strike price when it is at the money. If my strike price is $30 and the stock is at $40, I can buy the 100 shares at $30 instead of $40 and continue to make profit on the shares if the stock continues to rise. Exercising a put out the money is a little bit different. Imagine a strike price of a put option at $10. The stock drops to $9. The buyer of the put option has the right to buy the 100 shares at the strike price of $10. This doesn't make much sense for the buyer as he would be paying more than the shares are worth. This makes more sense for the seller of the put. You do not need 100 shares of the stock to sell a put. The seller can sell a put at a strike price, hoping the cost of the stock goes down. This way, the seller can buy the 100 shares needed for the buyer to exercise his contract at the lower price and resell the shares at the strike price if the buyer decides to exercise. This would net the seller a profit. If the strike price is $10, then the buyer of the put option would need to pay the $10 strike price times 100 shares per contract purchased for a total of $1,000 in this case. The seller of the put option can buy 100 shares at $7 and sell it at the strike price of $10 for a net profit of $300 minus the cost associated with selling a put, which is generally commissions, margin interest, and fees. Now that you have a better understanding of how calls and puts work, let's dive into the Greeks. Option trading has a lot of variables associated with each contract known as the Greeks. The Greeks give us an understanding of the underlying risks associated with each option contract. The Greeks can be very complicated and advanced traders leverage the Greeks in order to increase their chances of profitability by buying multiple contracts with different Greeks and strike prices. This can reduce your risk of loss. Now, we won't get too deep into the Greeks in this video, but I do want you to understand the basics so that you can make a smart decision if you do indeed decide to buy or sell an option. First, let's talk about delta. Delta is the probability that your option will expire at the money. For example, if your delta is 50, you have a 50% chance of your contract expiring at the money. Now, let's move on to gamma. Gamma is the rate of which the delta can change. This is expressed as a percentage. This is your implied volatility, meaning if the stock goes up and down significantly, it has a high volatility, and your gamma will be more stable and lower than if the stock has less volatility. As the expiration date of the contract becomes closer, the gamma of at-the-money options increases, while the gamma of in the money and out the money options decreases. When your option is close to expiration and you're already at the money, your gamma will be at its highest point. If you're far from being at the money, the gamma will be lower. Now let's talk about theta. Theta is important because it represents your time decay of your option. When you buy an option, the closer you are to your expiration date at the time of purchase, the higher your theta, or your time decay, will be. This is important if you are selling or buying an option. If you are selling, a higher theta is your friend because your goal is the option to expire worthless. If you are buying an option, the theta works against you because your option is becoming less valuable the closer you are to expiration, even if you are at the money. If you buy an option with an expiration date that is near, your theta will be higher than that of one that is far from expiring. Lastly, I want to talk about Vega. Vega is the rate in which the volatility occurs in that particular option. If you buy a long position option, meaning you intend to hold the asset for a longer period of time in order for it to gain in value, your Vega is going to be higher because the uncertainty of that stock price is higher. If the option is expiring sooner, your Vega will be lower because you have a better chance to predict which way the stock will move, thus reducing your risk. Now that you have a brief understanding of how options work, I highly encourage you to do more research on your own, as I cannot cover everything in this video. If you want to join my Stock Talk community, I will leave an invite for my Discord server below. Additionally, if you are looking for a trading platform, I will leave my referral code for Robinhood, which is what I personally use. You and I both will receive a free stock after you sign up. Thank you for watching, and I hope to see you next time.